My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Risk Management case study questions as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. First case study question is identifying and evaluating risk in a manufacturing company. From Unit 1, Concept, Identification and Evaluation of Risk. Case: Sharma Motors Pvt Limited, an Indian automobile parts manufacturer, is planning to expand to Southeast Asia. Before investing, the management wants to identify all possible risks. They discover product market risks like new competitor entry and capital market risks like currency fluctuation and rising interest rates. They also recognize possible risk events such as strikes, raw material shortage, and unexpected government policies. To manage this, the company follows a structured risk management process. They list risks, measure them using probability and impact, and evaluate which are most harmful. For example, they found that currency fluctuation could reduce profits by 15%. So, they decide to hedge currency risks using forward contracts and set up internal risk indicators like rising input costs and labor unrest. Questions and answers. 1. What are the two main types of risks Sharma Motors identified? Product market risk and capital market risk. 2. What is one example of a risk event mentioned in the case? A strike or raw material shortage. 3. Why did Sharma Motors use forward contracts? To manage the risk of currency fluctuation during export. Next case study question is using VAR and CAR in an investment decision. From Unit 2, Value at Risk and Cash Flow at Risk. Case: Arun is a financial analyst at HDFC Mutual Fund. He wants to invest 100 crores rupees in IT stocks. But he first calculates the value at risk, VAR, to estimate how much money could be lost with 95% confidence over 1 month. He finds that 6 crores rupees could be at risk. He also checks cash flow at risk, CAR, to see how it would affect the fund's monthly cash outflows. He uses stress testing by assuming bad conditions like a market crash and backtesting to check past accuracy of the model. Based on VAR and CAR, he decides to invest only 60 crores rupees and spread the rest in less risky bonds. This way, he balances return with risk. Questions and answers. 1. What is value at risk, VAR, used for? To estimate the possible financial loss in investments under normal market conditions. 2. Why did Arun use stress testing? To check how the investment performs in extreme conditions like a market crash. 3. What decision did Arun take based on VAR and CAR? He reduced equity investment and diversified into bonds. Next case study 3. Hedging commodity price risk using forward contracts. From Unit 3, Forward Contracts. Case: a rice exporting company in Andhra Pradesh has signed a contract to sell rice to a buyer in Dubai after 3 months. However, the price of rice in the market keeps fluctuating. The company is afraid that if the price falls, they will face losses. So, they enter into a forward contract with a local trader to fix the selling price today for delivery after 3 months. The contract states that 1 ton of rice will be sold at 32,000 rupees. Even if the market price drops to 28,000 rupee after 3 months, the exporter still gets 32,000 rupees as agreed. This helps them manage the risk of commodity price fluctuation. Questions and answers. 1. Why did the rice exporter use a forward contract? To protect themselves from a fall in rice prices. 2. What is a forward contract? An agreement to buy or sell an asset at a fixed price on a future date. 3. If market price falls to 28,000 rupees, how much does the exporter get as per the contract? 32,000 rupees, as per the forward contract. Next case study 4, interest rate swap between two companies. From Unit 4, interest rate swaps. Case. ABC Limited in India can borrow at a fixed rate of 9% or a floating rate of MIBOR plus 2%, while XYZ Limited in the US can borrow at MIBOR plus 1% or fixed 11%. ABC prefers floating and XYZ prefers fixed. They enter into an interest rate swap where ABC pays floating rate to XYZ and receives fixed 9% from XYZ. Both companies benefit by lowering their effective interest costs. This type of swap helps companies hedge the risk of changing interest rates. ABC is protected if interest rates rise, and XYZ is protected from fixed high interest burdens. Questions and answers. 1. What kind of financial agreement did ABC and XYZ enter into? Interest rate swap. 2. Why did ABC prefer a floating rate? Because it expected interest rates to go down. 3. How does the swap help both companies? It reduces their borrowing cost and manages interest rate risk. Next case study 5, using options to hedge investment risk. From Unit 5, Options and Black-Scholes Model. Case. Sana is an investor who bought shares of Infosys at 1,400 rupees each. She is worried that prices might fall in the next month. So, she buys a put option with a strike price of 1,350 rupees for 30 rupee premium. If the price drops below 1,350 rupees, she can still sell her shares at 1,350 rupees, reducing her loss. If the price stays above 1,350 rupees, she will not use the option, and her loss is only 30 rupees, the premium. This is an example of using options for risk management. Sana uses the Black-Scholes model to estimate whether the option premium is fair. Questions and answers. 1. What type of option did Sana buy? Put option. 2. Why did she buy the put option? To protect herself from falling share prices. 3. What is her maximum loss if she doesn't use the option? 30 rupees, the premium paid.